Let's check in on shares of Alphabet now turning positive as the U.S. Justice Department is considering a breakup of Alphabet's Google search engine, of the business that would basically mean that it can't allow some of its platforms like Chrome, like Android, like its app stores to favor Google search. This coming through documents that were filed with the court. And so the U.S. Justice Department is thinking about asking a judge in what is probably the most fulsome framework that we have seen on breaking up Alphabet. Let's bring in Paul Markham, investment director at GAM Investment Management, joining us now. Paul, thanks so much for joining us. The shares are modestly higher now, so I guess that maybe says it all about how threatened investors feel about this prospect.
Yes, I think, firstly, good morning. Firstly, these kind of processes in the US market take a long time. And I think that investors will probably move on to more pressing issues with Google. But that's not to say that this is not an important question. I think the thing that's leading us to be much more sanguine about this is that if you think about, for example, the placement of Google as the default search engine for Apple devices, most people, when they get a new Apple device, giving them the chance to select which search engine they use, they will probably go for Google anyway. And it means that Google is then not paying out $25 billion of its free cash flow every year for that. So on the whole, we think the valuation opportunity afforded by this is actually quite attractive for Alphabet.
I think that's a good perspective that, this breakup fear has been kind of lingering the company. But I hear investors like yourself increasingly talk about, well, wait a minute, even if it were to come to pass, isn't necessarily bad if you're a shareholder.
I don't think it is. And I think that there are some pretty compelling aspects to Alphabet, which mean that, on the 16 times earnings multiple that we have it on for next year, it looks pretty attractive. The growth is still quite robust. Clearly, there are cyclicalities in the business related primarily to advertising. And of course, it's always a little bit difficult as a shareholder to know exactly what the intellectual capital is within Google, because a lot of it is done in a kind of fairly opaque way. But we think that the multiples take that into account. And when you look at it relative, for example, to the other large cap tech stocks and the footprint that it has within the cloud, for example, we think it looks pretty good.
That multiple is quite stunning in the context of other tech peers, in the context of the broad market. It is trading cheaper, and that it is in that AI wheelhouse. Why does it trade at such a discount?
I think because the degree of transparency which Google is able to bring, and the fact that it is a kind of tech conglomerate, really. It does a lot of things. And of course, there's always been this overhang of the potential for there to be some kind of a split up, which is what the DOJ, of course, is discussing. And there's only really probably only an equivalent pressure for there to be a split up applied to Amazon. The rest of the large cap tech stocks aren't under quite the same pressure for that. I think that's certainly a reason. And I think, of course, there's always some measurement around the growth and the market share of the cloud, where Amazon has actually been doing much better than Google, and Microsoft has been doing better than Google as well. So I think all of those things are reasons to apply a discount to it. And we wouldn't claim that Alphabet should trade at a premium to some of those other names, particularly among the M7, because it does have some more question marks against it. But we think that they're over-penalized as we stand right now.
There's questions about the AI trade in general, even with stunning numbers and the CEO of NVIDIA saying, demand is insane. Take Taiwan Semi today, beating sales expectations. What's your favorite kind of AI trade right now? How much of the low-hanging fruit has already been plucked?
It's a really key question for investors right now, because for the last 18 months, we've seen this very strong leadership from NVIDIA within that space. And that's something, which has been justified given the fact that NVIDIA has been able to really get the jump on the competition around its ability to power NI with its chips. The question mark for us really at this stage is whether or not there is what you might call an air pocket with the adoption of AI, because many technology departments of corporates in particular will be looking sideways at their peers and kind of saying, well, how long is it going to take for this to become fully embraced? How much money do we want to spend in being first? And being first is not always an advantage when it comes to buying technological products or adopting new technology. And I think many business models will be keen to sort of just see how it works elsewhere. That may lead to a little bit of, once the initial gold rush is over, it may lead to a little bit of a pause, and that could mean that there is room for competition to catch up. We've certainly taken that into account. We're actually very aware of the fact that there is an AI day being held by AMD tomorrow, and we think that could actually be a positive development, as it was last year at the AMD AI Day. And AMD is probably positioned to capture some of the interim period between learning and inference, which is a key part of the story and of the progression from within AI. So we think that there is space for more than one player. The cake will grow, and NVIDIA can't expect to have all of that cake. I think there will be a bit of a proliferation of potential profit gainers from this space.
Okay, before I let you go, only 60 seconds left, but the Mag 7 have been recently the Lag 7 compared to the broader market. Do you expect the dominance to come back?
I think it's likely to have a pause for a bit longer, and clearly there are some valuation challenges around a couple of those names. And then, of course, you have something like Tesla, where there's a perception of there being maybe some issues, certainly ongoing around corporate governance, but also around maybe the ticket price of those vehicles, I think, is rather high. And it may be that some of the Chinese manufacturers can do that more cheaply. So I think, there is a bit of a mixed bag. We do think that Netflix looks quite good, given the fact that there is an emphasis now on advertising revenue rather than subs. So as a group, they may start to diverge a little bit, actually, especially if investors perceive that they're not kind of a homogenous mass of stocks. But for now, there is a chance that we get a little bit of different performance outcomes from the various names within that space.
Okay, thank you so much for joining us with all of that insight. I appreciate. That's Paul Markham joining us at GAM Investment Management.